Folks, you are not going to believe what the volatility index did this week. She walked into a firestorm of Middle East headlines, tariffs, threats, and central bank dissent, and she simply yawned. That is the story, the one moment that defined everything. While pundits on television screamed about war risks and supply shocks, the VIX opened the week near 19 and change and then refused to get excited. She stayed stubbornly in the high teens all the way down to 17 and 95 by Friday close. And the S&P 500, it parked itself right around 7,138 like it had nowhere better to go. Now ask yourself, when was the last time you saw fear this absent in the face of so much noise? This is exactly why you and I pay attention to what the tape actually shows instead of what the headlines are selling. This episode is brought to you by Iron Condor Command, the definitive guide that has helped thousands of traders master defined risk strategies with confidence. Let me take you back to Monday morning. Traders sat down at their desks with coffee still steaming and the weekend news still ringing in their ears. Iran nuclear headlines were everywhere, a proposal that sounded serious enough to move markets. At the same time, fresh tariff talk was making the rounds, with 25% duties threatened on any country still trading with Iran. CNBC told you this was the spark that could ignite a broader conflict. What the tape actually showed was something far more interesting. Crude oil climbed from $96.37 all the way toward 100 before the week even got rolling. That move made sense on the surface. Energy markets pricing in potential supply disruption from the Gulf. But here is where it gets interesting. Gold, which usually loves geopolitical tension, actually weakened from $4,675.40 down toward $4,591. That divergence told you right away that smart money was not buying the panic narrative. They were hedging differently. The volatility index opened the week at 18.55. She looked at all of it, the oil spike, the tariff threats, the lingering uncertainty around Fed policy, and she refused to budge higher. Instead, she started a gentle drift lower. By Tuesday close, she had already slipped below 18. That is not normal behavior when the news flow reads like a thriller novel. You and I know what really happened here. Institutions had already priced these risks weeks earlier. The put buying we saw in the options market was insurance, not speculation. It was quiet rotation into tech names, while they layered on out-of-the-money protection just in case. Meanwhile, the dollar climbed from 98.48 to 98.62. That firming dollar should have pressured risk assets. Yet the S&P 500 refused to break lower. It stayed essentially flat. That disconnect between a stronger dollar and stable equities was the first clue that this week would reward patience over panic. Now listen, the Fed kept interest rates steady this week. No surprise there, but the dissenters spoke up loud and clear. Some said the next move could be a cut. Others warned it might need to be a hike if inflation reaccelerates. Treasury yields edged higher from 4.34% to 4.35% on Tuesday. The bond market was listening to those inflation concerns tied to the oil move, yet equities barely flinched. This is what I mean when I say the tape and the math outweigh headline noise. The VIX was whispering the entire time. She was telling anyone who would listen that realized volatility simply was not showing up. The daily ranges stayed inside what our expected daily range model projected. That is why our RSAI engine fired a place signal every single day. Conservative tier targeting around 70 cents per contract, balanced around $1.15, aggressive $1.60. All of them collected cleanly because the market refused to deliver the volatility the pundits promised. Tuesday brought even more noise. The surprise announcement that the United Arab Emirates would leave OPEC. Headlines called it a fracture in the Gulf Alliance at the worst possible time, with tensions around Iran still boiling. Oil responded by pushing toward $99.93. That is real money moving in the energy complex. Yet gold kept sliding toward 4,545 by Wednesday. The safe haven that should have been screaming higher on Middle East supply risks was instead taking a breather. That told you the fear was contained. Institutions were buying the dollar and layering on protection, but they were not fleeing equities entirely. The volatility index by this point had settled into what I can only describe as a smug posture. She sat there between 17 and 19, almost laughing at the panic. She had seen this movie before. Headlines scream. Markets price it in early. Realized moves stay modest. And short volatility strategies get paid. This setup was textbook for what we do at VixShield. We place our iron condors between 3:05 and 3:14 in the afternoon Central Time. Cash settled on the S&P 500. No shares, no assignment risk. Each trade independent. Monday expires Tuesday. Tuesday expires Wednesday. Clean slate every day. That discipline matters especially when geopolitics tries to grab the wheel. The 25% tariff threat on Iran, trading partners, the Fed holding rates with vocal dissent, the UAE exit from OPEC, all of it created the kind of uncertainty that normally lifts volatility. But the VIX was having none of it. She declined steadily. That gentle decline from 18.55 to 18, even by Tuesday, close signaled that realized volatility was absent. The term structure stayed in healthy contango, meaning longer dated volatility was priced richer than the near term we were selling. That structure pays you to be short near term fear when fear refuses to show up in actual price movement. And honestly, this was one of those weeks where the character of the volatility index revealed everything. She was not scared, she was almost bored. While oil ran toward $106.88 midweek, the VIX simply would not break 20. That refusal to get excited is what smart option sellers live for. It is the market telling you the risk is in the pricing already. Your iron condor wings can be placed with confidence when the expected daily range model and the RSI signal align. We do not chase, we do not predict. We collect premium inside a defined risk structure that does not care what the headline says, only what the math delivers. By the end of Tuesday, you could feel the week taking shape. The central tension was clear. Would all this geopolitical fire finally force the VIX to wake up, or would she keep yawning and hand premium to disciplined sellers day after day? The early evidence pointed firmly toward the latter. Then Wednesday changed the conversation. Oil surged again, this time all the way to $106.88. The Iran conflict headlines intensified. Moscow was calculating its benefits from the Gulf tensions. Ukraine remained a four-year crossroads of Europe and Russia, with fresh lessons emerging. The war in the Middle East was entering its second week and reshaping global energy markets, according to multiple reports. CNBC told you this was escalation that could not be ignored. The bond market, however, showed something different. Yields pushed to 4.42%. That move reflected inflation fears from higher energy costs more than outright panic. The dollar climbed to 98.92, its firmest level of the week. Yet equities refused to sell off. The S&P 500 stayed range-bound near 7,138. That is not the behavior of a market suddenly afraid of broader conflict. That is a market that had already digested the risk. Here is where the first unexpected connection appeared. Bitcoin slipped from 77,367 down toward 75,776 while all this was happening. Crypto often leads risk appetite. Its quiet decline suggested institutions were trimming speculative exposure even as they kept the broad indexes stable. Ethereum followed suit, dropping from 2,303 to 2,253. Yet by Thursday, both started to stabilize. That recovery in crypto, while oil remained elevated above 100, told you something deeper was at work. The risk-off move was selective. Energy and defense names saw flows. Tech continued its quiet rotation higher. The volatility index noticed all of it. By Wednesday, she had dropped below 18. She was not whispering anymore. She was practically smirking. The VIX refused to break 20 even as pundits warned of growing anxiety after a week of wild swings. Options market signals showed some put buying for protection, but nothing that suggested a regime change. Thursday brought the second twist. The dollar reversed sharply, falling back from 98.92 to 98.08. That retreat should have been bullish for gold. Instead, gold only recovered modestly from 4,545 to 4,614. The safe haven asset that everyone expected to rally hard on Iran nuclear news and tariff escalation was behaving as if the tension was already in the price. This is what I find fascinating. The tape showed these geopolitical stories had been priced in weeks ago. What the headlines sold as fresh panic, the bond market had already reflected in slightly higher yields. The equity market simply stayed flat. That disconnect is where the real edge lives for those of us who trade defined risk structures. The second unexpected connection came in the forex market. The euro-dollar pair dipped to 1.169 on Wednesday, then recovered to 1.173 by Thursday. That stability in the euro, while the dollar swung, suggested global capital was not fleeing to the safety of the greenback in a disorderly way. It was measured rotation. Meanwhile, the VIX continued its smug decline. She settled near 17.95 by Thursday close. She looked at the UAE leaving OPEC, the Trump executive order promises on artificial intelligence limiting state rules, the talk of tariffs resuming between the United States and China, and she simply refused to spike. That is character. That is personality. The volatility index was telling us that realized moves were staying inside the expected daily range. Our RSAI engine kept firing place signals right in the 310 to 314 window every afternoon. No holds, 5 consecutive place days. That pattern is rare, and it reveals exactly what kind of week we lived through. Now this is where it gets even more interesting. Europe began rethinking its crackdown on big tech. Headlines talked about loosening reins on artificial intelligence, while the United States appeared ready to take them off entirely. Trump promised an executive order to block state-level artificial intelligence regulations. That policy noise should have created uncertainty in the tech-heavy S&P 500. Instead, tech outperformed while consumer names lagged. The rotation was quiet and mechanical. Institutions were buying the dip in quality growth names, while hedging the broader portfolio with cheap, out-of-the-money puts. The iron Condor sellers among us simply collected the credit and let Theta do the work. Conservative tier collected its steady 70 cents. Balance delivered 115. Aggressive captured 160 on days when the setup allowed. All independent. All expiring the next market day. No carryover, no emotional adjustments. That mechanical discipline is what separates those who last in this business from those who do not. The third twist arrived when the market tested the upper end of its recent range on Thursday afternoon and failed to break through. That failure was subtle but clear on the tape. Volume on the upside dried up. The VIX ticked slightly higher intraday, only to fade again into the close. She was almost taunting the bears. You expect me to spike on all this Iran war energy, market reshaping tariff resumption talk, and I will not. That refusal to break higher is what handed premium to short volatility strategies all week long. Our adaptive layered VIX hedge, known as ALVH, sat in the background doing its quiet work. 4 parts short term, 4 parts medium term, 2 parts longer dated VIX calls per 10 iron Condor contracts. That structure trims drawdowns during any spike at an annual cost of only 1 to 2%. It is insurance that pays for itself when the VIX behaves exactly like it did this week. Stubborn, calm, contained. Friday brought the resolution, and it was as satisfying as it was quiet. Oil gave back some of its gains, closing at $101.94. The fever around the Gulf energy crisis seemed to ease. The dollar stabilized near 98.21. Gold recovered slightly to $4,629.90, but still ended the week lower than where it started. That entire move in gold from 4,675 down and then partially back told the real story. Geopolitical risk was real, but it was not the kind that sends investors scrambling for any asset with a heartbeat. It was the measured kind, the kind that institutions hedge with a mix of dollar strength, selective equity exposure, and volatility protection that does not require massive portfolio shifts. The S&P 500 settled right where it had lived all week, near 7,138. Flat on the week. No breakout, no breakdown. Just range-bound trading inside the expected daily range our models projected. The volatility index closed at 17.95. She had declined steadily from her opening levels and never once threatened to break out of that 17 to 19 zone. That is not a market in panic. That is a market that looked at tariffs on Iran, trading partners, the Fed keeping rates steady, with dissent, the UAE quitting OPEC, the ongoing calculations around Ukraine, and the Iran conflict, and said, "We have seen this before." The tape showed these risks were largely priced in. What the mainstream financial media called a wild week of swings, the options market viewed as contained volatility worth selling. This is where our VixShield strategy proved its worth once again. 5 place signals, 0 holds. Every afternoon between 3:10 and 3:14, our RSAI engine optimized the strikes for maximum credit while staying inside the wings defined by the expected daily range. Conservative traders collected their steady premium with roughly 90% historical win probability. Balanced and aggressive tiers stepped in when the setup permitted delivering larger credits on days when the VIX stayed suppressed. Each trade stood alone. When Friday afternoon arrived, every position from the week had already expired on its own schedule. 3 trades expired worthless for full credit. The one that brushed a short leg did so inside the defined risk parameters. No guessing, no hoping, just mechanical execution of a system built for exactly this kind of environment. The term structure remained in contango the entire week. That normal, healthy state where longer dated volatility costs more than the near term we sell is what allows iron condors to thrive. We are not guessing direction. We are providing liquidity and collecting the difference between implied and realized. When realized stays low, as it did this week, the math works beautifully. Our temporal theta martingale approach stayed on standby. It only activates when the expected daily range expands above 0.94% or the VIX pushes above 16. Neither gate was breached in a way that required action this week. That is the beauty of rules-based discipline. You do not have to make decisions in the heat of the moment. The system tells you when to roll forward in time, to capture Vega expansion, then roll back to harvest accelerated theta. 88% of threatened positions recover without adding capital or using stop losses. That is not hope. That is tested mathematics meeting real-world geopolitics. The resolution on Friday felt like the market taking a deep breath. The VIX had maintained her calm demeanor all week. She refused to get excited about the second week of the U.S.-Israel-Iran conflict. She ignored the fractures in the Gulf alliance caused by the UAE leaving OPEC. She looked at the resumption of trade war rhetoric between the U.S. and China and the elusive India-U.S. trade deal and simply stayed in her lane. That kind of consistency rewards those who trust structure over story. Our iron condors did exactly what they are designed to do: deliver repeatable income inside defined risk parameters while the world argues about tariff central bank policy and military calculations in the Middle East. The week proved once again that policy geopolitics and inflation narratives create noise. The math creates edge. Now let us pull back and look at the bigger picture, because this week the invisible threads between assets told a story that the pundits completely missed. Gold weakened even as oil surged and tensions rose. That is the first unexpected connection that matters. Normally gold and crude move together on Middle East risk. This time gold looked at the strongest dollar readings midweek at 98.92 and said not today. The inverse correlation broke down because institutions were hedging differently. They bought the dollar. They bought selective equity exposure. They bought out of the money puts for insurance. But they did not pile into precious metals the way fear trade would suggest. That tells you the risk was perceived as containable, the kind that affects energy and defense budgets but does not threaten the broader financial system. The dollar index itself provided the second unexpected thread. It climbed steadily through Wednesday, reaching 98.92, then reversed. That peak in the dollar coincided with the highest oil print of the week at $106.88. Energy prices and a strong dollar usually pressure equities. Yet the S&P 500 refused to crack. That resilience revealed institutional confidence that the Fed would manage the inflation implications from higher energy without derailing the expansion. Yields rose to 4.42% and then eased back. The bond market whispered inflation concerns. Equities listened but did not overreact. That measured response is what kept realized volatility low and handed premium to iron condor sellers day after day. Crypto delivered the third unexpected connection. Bitcoin and Ethereum both dipped midweek as oil and geopolitical headlines intensified. Many would have expected crypto to crash harder on risk-off sentiment. Instead, the decline was orderly and shallow. By Friday, both had recovered, with Bitcoin closing at 78,179. That recovery, while the VIX continued to decline, suggested institutions were using crypto as a barometer of risk appetite rather than a fear gauge. They trimmed when uncertainty peaked, then added back when the VIX refused to confirm the panic. That behavior lines up with what we saw in equities: quiet rotation into tech, selective hedging, no wholesale liquidation. The volatility index noticed. She stayed smug. She stayed below 19 for most of the week. Her personality this week was that of the wise old friend who has seen every crisis and knows which ones actually matter. The euro-dollar pair remained remarkably stable between 1.169 and 1.173. That stability, while the dollar swung and oil moved double digits, tells you global capital flows were not in panic mode. Europe rethinking its big tech crackdown and loosening reins on artificial intelligence aligned with American moves to limit state-level AI rules. That policy convergence reduced regulatory uncertainty in the tech sector exactly when geopolitical uncertainty was rising elsewhere. The market rewarded that clarity with steady tech performance, even as consumer names lagged. These cross-asset threads all pointed to the same conclusion. The geopolitical noise from tariffs, the Iran conflict, the OPEC fracture, and central bank dissent was real. But it had been anticipated. The tape had priced it. The volatility index confirmed it by refusing to spike. That confirmation is what allowed our defined risk iron condors to perform exactly as designed. Protection against uncertainty without needing to predict which headline would matter most. When you step back and connect all the dots, you see why VixShield exists. Geopolitical chaos, from the 4-year lessons of the Russia-Ukraine war to the current reshaping of energy markets by the Iran conflict, creates the kind of environment where emotions run hot. Tariffs on Iran, trading partners, the resumption of U.S.-China trade friction, the elusive India-U.S. deal, all add layers of policy uncertainty. The Fed holding rates while dissenters warn of either cuts or hikes adds monetary complexity. Yet through all of it, the math of contango, low realized volatility, and range-bound trading delivered opportunity for those willing to stay mechanical. Our iron condors do not care about the narrative. They care about where the S&P 500 closes relative to our wings. That focus on math over media is the conservative truth-seeking approach that has always served patient capital best. So let us talk about the scorecard in the context of the story we just lived through. 5 trades placed, 5 place signals from the RSI engine. 0 times did we receive a hold. That perfect record across conservative, balanced, and aggressive tiers tells you everything about the regime. The VIX stayed below 20 the entire week. The expected daily range never expanded enough to trigger caution. The term structure paid us to sell near-term volatility because realized volatility never showed up to collect. Conservative tier collected its reliable 70 cents per contract with that 90% historical win probability intact. Balance delivered 115 on most days. Aggressive captured 160 when the setup aligned perfectly. 3 of the 5 trades expired worthless for full credit. 1 brushed a short leg but stayed inside the defined loss parameters. 1 finished cleanly in between. That is not a dramatic scorecard. That is a disciplined one. And in markets dominated by geopolitical noise, discipline is the only edge that survives. The week reinforced the core takeaway. When the volatility index refuses to spike amid tariff threats, central bank dissent, energy market fractures, and military calculations in the Middle East, she is handing premium to those who use defined risk structures. Our adaptive layered VIX hedge remained in place the entire time, trimming any potential drawdown at minimal cost. The temporal theta martingale stayed on the bench because it was not needed. That is the beauty of a rules-based system. It knows when to act and when to stay quiet. The discipline lesson this week is simple. Trust the tape over the pundits. When every major geopolitical story, from the UAE leaving OPEC to the second week of conflict reshaping energy markets, fails to move the VIX out of its complacent range, the math is speaking louder than the headlines. Stay mechanical. Place your iron condors in the 310 window. Let them expire. Repeat. That approach turns policy uncertainty into repeatable income. It protects capital while others chase narrative. This week, the VIX was the ultimate character in the story. She yawned at the oil spike. She smirked at the tariff announcements. She whispered calm when everyone else was shouting fear. Her steady decline from 18.55 to 17.95. While gold, oil, the dollar, and crypto all told their own conflicting tales, proved that realized volatility remains the only thing that truly matters. The headlines said escalation. The tape said priced in. Our iron condors listened to the tape, and they collected. Tomorrow in our Sunday forecast, I will walk you through exactly what I am watching Monday morning. The economic calendar, the volatility term, structure setup, and precisely how our iron condor wings will be placed depending on where the VIX opens the new week. The geopolitical threads we discussed today are not going away. They will evolve, and our system is built to evolve with them. You will not want to miss how the expected daily range and RSI signals are aligning for the week ahead. And be sure to listen for any breaking news from Miss Vicky. If you found this summary valuable, consider upgrading to Pro or higher for the full twice-daily VixShield market summaries, proprietary signals, and private RSS feed. Visit VixShield.com to learn more. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution, signals only. Past performance is not indicative of future results. And now you know what the tape was really saying this week. This is VixShield, your protection against market uncertainty.